All right, let's get right into it. Today, we're going to talk about something that I swear is the single most important skill for actually surviving long-term in trading. We're talking about position sizing.
You know, this quote just nails it. So many traders, maybe you've done this too, we get completely obsessed with finding the perfect entry, the magic indicator. But all the while, our success or failure is being driven by this invisible force that we barely even think about.
I want you to really let that sink in for a second. This idea, it flips the whole trading world upside down. It's not about being a genius predictor. It's about defense. It's about making sure you can stay in the game long enough for your strategy to actually work. So here's the plan. We'll kick things off with why sizing is your superpower. Then we'll get into the nuts and bolts, the core formula. We'll apply it to real-world assets like gold and Bitcoin, check out some advanced methods, and then get into the really crucial part, the psychology of it all. And of course, we'll wrap it up with your key takeaways.
Okay, first section. Now, I know calling it a superpower sounds a little dramatic, but trust me, by the end of this, you'll see why. This is the bedrock of professional risk management. It's truly what separates the people who are just gambling from those who are treating this like a serious business. So what is it really? Well, at its core, position sizing is just a process. It's the tool that answers the one question you have to ask before every single trade. How big should this be? It's not about what you're trading, it's about how much of your hard-earned capital you're going to put on the line for this one idea.
And this right here, this is the big mindset shift. Most traders live on the left side of this screen. They're chasing that high win rate, needing to be right all the time. But guess what? A couple of massive, poorly sized losses can completely erase dozens of small wins. The pros? They live on the right. They accept that they're going to be wrong a lot. So they obsess over one thing, making sure that when they are wrong, the damage is tiny and manageable.
This is the perfect analogy. Think about it like a poker game. Your trading capital, that's your stock of chips. If you go all in on a weak hand and lose it all, it doesn't matter if you get dealt pocket aces on the very next hand. You're out. You've lost your seat at the table. Position sizing is what ensures you always have enough chips to play another day.
So how do we actually do this? How do we turn this defensive mindset into something practical? Well, it's not about feelings or guesswork. It's about a dead simple formula that you can use on every single trade you take. And it all boils down to these three things. I call them the holy trinity of sizing. They're non-negotiable. First, you have to know your exact account size. Second, you must decide on a fixed percentage of that account you're willing to lose on any single trade. Most pros stick to somewhere between 0.5% and 2%. And third, you need to know your stop-loss distance in dollars, where you're going to say, I'm wrong, and get out. And here's how it all comes together. Let's walk through it. First, you calculate your account risk in dollars. In this example, with a $10,000 account and a 1% risk, that's $100. Simple. Then, you look at your trade risk per share. Here, you're buying at $10 and your stop is at $8, so your risk is $2 per share. You just divide the $100 by $2 and boom, 50 shares. That's it. That is the absolute maximum you can buy if you want to honor your $100 risk limit. Okay, so that's the theory. But let's make this real. Let's take that formula and apply it to two completely different animals in the market, gold and Bitcoin, and see how it automatically keeps us safe.
Now look closely here. The setup is identical for both trades. Same $10,000 account, same 1% risk. That means no matter what happens, the absolute most we can lose on either of these trades is exactly $100. That's our line in the sand. But here's the difference, the stop loss. Gold is pretty stable, so maybe a $10 stop makes sense. Bitcoin, it's the Wild West. It needs a much wider $500 stop just to breathe.
So let's plug the numbers in. For our gold trade, we take our $100 risk and divide it by that $10 stop. That tells us we can trade 10 units. Easy enough. Now for Bitcoin, we take that same $100 risk, but this time we divide it by that massive $500 stop. The result? We can only trade 0.2 units of Bitcoin. And this, right here, is the absolute magic of position sizing. Do you see it? Your risk, the amount of money you can actually lose, is identical in both scenarios. It's $100. The formula automatically forces you to take a smaller and smaller position in more volatile markets. It's like an automatic risk manager. It normalizes your risk across your entire portfolio, no matter how crazy things get.
So once you've truly mastered that core formula, it becomes this amazing foundation you can build on. Because that 1% rule, it's a fantastic place to start, but it's not the only way to do things.
So let's just quickly touch on a few ways you can level up. You got progressive exposure. This is where you might bump your risk up to, say, 1.5% when you're on a winning streak, but then you cut it back to 0.5% when you're in a drawdown. Then there's volatility-based sizing, which often uses an indicator like the average true range, or ATR. This makes your stop-loss dynamic, adapting to the market's recent behavior. Quality-based sizing is just common sense. You risk a little more, maybe 2% on your absolute best A-plus trade setups. And finally, scaling in, where you start with a small position and add to it as the trade proves you right. But, all these numbers and formulas, they are really just tools. Tools for managing the one thing that will wreck your account faster than anything else, your own brain. This is where sizing goes from just being math to becoming a tool for real mental mastery. Because look, when you trade too big, and we've all been there, you're not trading your system anymore. You're just staring at your P&L, riding an emotional roller coaster. Fear makes you cut your winners short, and greed, or maybe hope, makes you hold on to your losers way too long. A properly sized trade takes the emotion out of it. You already know your maximum loss is acceptable. It lets you be objective and just execute your plan. And that last point is so crucial. If you lose 50% of your account, you need a 100% gain just to get back to even. Proper sizing prevents you from digging a hole that deep.
So the key here is that increasing your size is a privilege. It is not a right. You don't just do it because you feel lucky or because you want to make back money you lost. No way. It's a reward for consistent, disciplined trading that shows up in your results. You have to earn it. All right, we have covered a ton of ground, so let's just boil this all down to the absolute most important things you need to walk away with today.
If you remember nothing else, remember these 4 things. 1. Your survival as a trader has way more to do with your position sizing than your fancy entry signal. 2. Always use the formula: account size, risk percent, and stop-loss distance. 3. Adjust for volatility. The wilder the asset, the smaller your position must be. And 4, this is the key to mastering your own mind. It's how you manage fear, how you manage greed, and how you build real discipline.
And that's a wrap. But I want to leave you with a question. I want you to really think about your own trading. What percentage risk are you actually using on each trade? Is it consistent? Is it based on a plan? Let us know down in the comments. I'd love to hear your approach, and it's a fantastic way for all of us to learn from each other. Thanks for tuning in.